decision that could spell relief for many Mauritius-based investors. This week, the Punjab and Haryana High Court has reiterated that a Mauritian tax residency certificate is sufficient to avail treaty benefits. Menaka Doshi says this reiteration is important given the continuous litigation regarding Indian-Mauritius tax treaty benefits. Listen in.
It's an interesting case, and let me get you the backstory first. In 2011, Blackstone Mauritius sold 66.29% and Barclays Mauritius sold 12.75% of equity in SKR BPO to Serco. SKR owned 100% of BPO service provider Intellinet and 20% of another BPO, Sparsh. Blackstone and Barclays both applied to the Advance Ruling Authority seeking an advance ruling on the taxability of the transaction in India and whether Serco was to withhold tax before making the purchase payment. The premise was that since both sellers were Mauritius-based entities, they would be exempt from Indian capital gains tax under the India-Mauritius Double Tax Avoidance Treaty. After a 3-year delay, the AAR declined to give a ruling on the basis of a prima facie finding that the transaction was designed for the avoidance of income tax. The matter then went to the Punjab and Haryana High Court, where Revenue argued that the entire transaction was nothing but a device for taking advantage of the double tax avoidance treaty between India and Mauritius. It was a case of treaty shopping, and Revenue argued that Blackstone and Barclays cannot be considered to be residents of Mauritius as they have absolutely no business interest in Mauritius. Hence, Revenue argued that the residency certificate issued in favor of Blackstone and Barclays is irrelevant. But the High Court disagreed. It set aside the AAR ruling and declared that no capital gains tax was payable by Barclays and Blackstone, nor was there any withholding tax liability on Serco. Now, the High Court decision reiterates two very important views: that it is incumbent upon the authorities in India to accept the certificates of residence issued by the Mauritian authorities, and on treaty shopping, it said, entering into a treaty and terms and conditions thereof are the sovereign functions involving important aspects of policy. To be clear, these views of the Punjab and Haryana High Court are not new precedent. The High Court has reiterated the Supreme Court's views in the famous Azadi Bachao Andolan case. But it's an important reiteration. Senior advocate Poris Kaka explains why. By the way, he represented Serco in the matter.
This brings us up to date. Azadi, as I pointed out, was 2002. There has been a lot of developments, circulars, amendments, proposed amendments, instructions, things like that. So I think there has been a little toing and froing. At one stage, if you recollect, there was a finance bill which said a circular will not be sufficient. You will require something more. Then the finance minister went back on it. So I think this really brings us up to date with the status of the current law. And again, I'm emphasizing current law because Parliament and the Central Board can change it when they want, of the status of the current law with regard to the Mauritius Treaty.
There you have it then. Given how litigated the Mauritius tax treaty benefits are, just as Poris explained, this ruling assumes importance and offers relief to investors using that route. But of course, the ultimate determination will be if the Indian government can for once and for all decide whether it wants to grant in reality the benefits it has agreed to in signing the treaty. Until, of course, the treaty is rewritten, and we know that is imminent too. With that, it's back to you.
Well, I guess only time will tell if North Block will indeed provide that clarity, if this High Court ruling will also be appealed against in the Supreme Court.